In the world of finance, few stories have burned as brightly and collapsed as spectacularly as the saga of FTX. In less than 3 years, this cryptocurrency exchange went from being hailed as the future of digital finance to becoming one of the biggest scandals in economic history. At the center of it all was Sam Bankman-Fried, a tousle-haired MIT graduate who styled himself as a visionary, a philanthropist, and a champion of the crypto revolution. Billions of dollars flowed through his empire. Celebrities lined up to endorse it, and governments welcomed him as a rising star in the fintech arena. But behind the glossy sponsorship deals and Silicon Valley charm lay a labyrinth of risky bets, secret transfers, and questionable alliances. The downfall would be swift, brutal, and deeply humiliating, not just for Sam, but for investors around the globe who had placed their trust and fortunes in FTX. As the walls closed and accusations of fraud and mismanagement mounted, pulling back the curtain on a tangled web that connected high-stakes trading floors to political corridors. This wasn't just another company in trouble. This was the unraveling of a crypto empire whose collapse sent shockwaves through the entire industry. And the most chilling part: the warning signs had been there all along, hiding in plain sight. Sam Bankman-Fried's journey to the top of the cryptocurrency world began in an unlikely place, a quiet suburb in California, where he was born in 1992 to 2 Stanford Law School professors. Growing up in an academic household, Sam was immersed in complex discussions about economics, ethics, and the law from an early age. Known for his sharp intellect and unconventional problem-solving skills, he gravitated toward mathematics and game theory, showing an early knack for analyzing systems and finding loopholes. This analytical mind would become both his greatest asset and ultimately his downfall. After attending the Massachusetts Institute of Technology, where he majored in physics and minored in mathematics, Sam entered the high-pressure world of quantitative trading. His first major role was at Jane Street Capital, a Wall Street firm, where he specialized in arbitrage buying and selling assets in different markets to exploit price differences. It was here that Sam refined his skills in risk management, complex financial modeling, and high-frequency trading. But more importantly, it was where he learned the art of moving large sums of money quickly and discreetly. In 2017, sensing an opportunity in the fast-growing but chaotic cryptocurrency market, Sam left Jane Street and founded Alameda Research, a quantitative crypto trading firm. Alameda's success was built on exploiting inefficiencies in global markets, including a famous arbitrage opportunity between Bitcoin prices in the United States and Japan. That trade alone reportedly netted millions and established Sam as a rising star in the crypto scene. But Alameda was just the beginning. In 2019, he launched FTX, a cryptocurrency exchange designed to cater to both retail and institutional investors. FTX promised advanced trading features, low fees, and innovative products like tokenized stocks and prediction market services that set it apart from competitors. Sam marketed FTX as not just another exchange, but as the future of finance, positioning himself as the industry's responsible face, in contrast to the reckless image many associated with crypto. Backed by aggressive marketing and strategic partnerships, FTX quickly attracted high-profile investors, including venture capital giants like Sequoia Capital and SoftBank. Within 2 years, FTX's valuation skyrocketed into the tens of billions, and Sam was being hailed as the JP Morgan of crypto. He cultivated a public image as a humble billionaire, often seen in t-shirts and shorts, sleeping on beanbags in his office, and pledging to give away most of his fortune to charitable causes. This persona, combined with his seemingly unstoppable business growth, drew in not only retail traders, but also Wall Street veterans who saw FTX as a bridge between traditional finance and the wild frontier of cryptocurrency. Yet beneath the image of the quirky genius building a safer, more accessible financial system, early cracks were forming. Alameda Research and FTX shared more than just a founder. They shared infrastructure resources, and as would later be revealed, much of the same money. For now, though, few were looking closely. The headlines were all about the meteoric rise, the innovative trading products, and the young billionaire who claimed he was going to change the world. It was a story too good to question, or so it seemed. FTX's rise from a little-known startup to one of the most powerful players in the global crypto market was nothing short of meteoric. From the very beginning, Sam Bankman-Fried understood the importance of visibility and credibility in an industry notorious for volatility and distrust. He poured resources into building FTX's brand-securing naming rights to the Miami Heat's home arena in a 19-year, $135 million deal, plastering the company's logo on Formula One race cars and even running high-profile ads during the Super Bowl. These moves didn't just target crypto enthusiasts. They aimed to bring FTX into mainstream consciousness, appealing to everyday consumers who might never have considered buying digital assets before. Celebrities became a cornerstone of the strategy. FTX inked endorsement deals with sports legends like Tom Brady and Stephen Curry, positioning them as ambassadors for the platform. These figures brought not only star power, but also a sense of legitimacy to the exchange. For many, if their sports heroes trusted FTX, then it must be safe. Meanwhile, venture capital poured in. By 2021, FTX had raised billions in funding rounds from blue-chip investors, driving its valuation to a staggering $32 billion. This astronomical figure made FTX one of the most valuable private companies in the world, and Sam, barely in his late 20s, was being compared to Silicon Valley icons like Mark Zuckerberg. Yet the expansion wasn't just about branding. FTX aggressively rolled out new products and features that pushed the boundaries of crypto trading. Users could buy and sell cryptocurrencies with lightning-speed trade, tokenized versions of traditional stocks, and even speculate on the outcome of political elections through prediction markets. The platform's ease of use and sophisticated tools attracted both novice traders and institutional heavyweights. This combination of accessibility and high-end functionality helped FTX quickly carve out a dominant position in the market. The company also positioned itself as a responsible industry leader. While other exchanges faced scrutiny for enabling risky or illegal activities, Sam appeared before Congress to advocate for clearer regulation and consumer protection in the crypto space. He presented himself as the adult in the room, a trustworthy steward who could guide the industry into a new era of legitimacy. This narrative played well with lawmakers and the public, further boosting FTX's image. But behind the scenes, the lines between FTX and Alameda Research were becoming increasingly blurred. Alameda, still under Sam's control, was not just another customer on the exchange. It enjoyed special privileges, including faster transaction speeds and exemptions from certain risk limits. These advantages allowed Alameda to make massive leveraged bets that would have been impossible for ordinary traders. While few outside the inner circle knew the extent of this relationship, it was a critical piece of the puzzle that would later explain how the empire came crashing down. For now, however, the illusion of stability and success held strong. FTX was expanding into new markets, lobbying for favorable legislation, and continuing to amass a loyal user base. Every headline, every sponsorship, and every glowing investor report seemed to confirm the same story: FTX was the future of finance, and Sam Bankman-Fried was the man who would lead it there. But as with many stories built on rapid growth and unchecked ambition, the higher they climbed, the more devastating the fall would be. While the public marveled at FTX's growth, the company's most dangerous flaw was hiding in plain sight: its intimate, almost inseparable relationship with Alameda Research. On paper, Alameda was an independent quantitative trading firm specializing in crypto arbitrage and market making. In reality, it functioned more like FTX's secret engine, fueled not just by its own capital, but as would later be revealed by billions of dollars of FTX customer deposits. The connection between the two entities was deeper than most outsiders realized. They shared office space in a luxury penthouse in the Bahamas, staffed by a tight-knit group of employees, many of whom were friends or romantic partners. Decisions were often made informally over casual conversations rather than formal meetings, blurring the lines between two companies that were supposed to operate independently. This cozy arrangement gave Alameda unique advantages on the FTX platform. It could place massive trades without the same margin requirements that applied to other users. It could take on higher leverage, borrow larger amounts, and critically avoid having its positions liquidated when markets moved against it. This meant Alameda could survive losses that would wipe out ordinary traders, essentially allowing it to gamble with borrowed chips that weren't its own. Those borrowed chips, according to investigators, increasingly came from FTX customer funds. The alleged mechanism was simple yet insidious. When Alameda needed liquidity for a risky trade or to cover a loss, money from FTX accounts would be quietly funneled over, bypassing the safeguards meant to protect customer assets. On the surface, both companies maintained a facade of independence, but in practice, the boundaries had dissolved. Alameda's aggressive trading strategies, fueled by this backdoor access to billions, created a hidden time bomb. As long as crypto prices stayed favorable, the scheme could continue without detection. But the volatile nature of the market meant that even a single downturn could trigger catastrophic losses. Meanwhile, FTX's leadership, including Sam Bankman-Fried and his inner circle, appeared unfazed by the growing risk. Publicly, Sam projected calm confidence, telling interviewers that FTX was financially sound and well managed. He continued to court regulators, donate to political campaigns, and build his image as crypto's trustworthy ambassador. Behind closed doors, however, Alameda's bets were becoming more desperate. The firm's exposure to high-risk tokens and speculative ventures left it vulnerable to even minor market swings. And because its losses were intertwined with customer deposits, the danger wasn't just to Alameda, it was to the entire FTX empire. Some employees began to notice the red flags, accounting gaps, unexplained transfers, and an opaque decision-making process where only a handful of people had the full picture. But in an environment dominated by loyalty to Sam and the belief that FTX was untouchable, dissent was rare and easily dismissed. The stage was set for a crisis of unprecedented scale, one that would not only destroy two companies, but also shake the foundations of the global cryptocurrency market. All it would take was a spark. The spark came in early November 2022, when a leaked balance sheet from Alameda Research landed in the hands of reporters at CoinDesk. The document painted a troubling picture. A large portion of Alameda's assets consisted of FTT, the proprietary token issued by FTX, rather than cash or more stable cryptocurrencies. Even worse, Alameda had used this highly illiquid token as collateral for massive loans. The revelation raised an alarming question: if FTT's value dropped, both Alameda and FTX could face a liquidity crisis. Within days, the market responded with brutal speed. Binance, FTX's biggest competitor and an early investor, announced it would sell its entire holdings of FTT, citing recent revelations about the company's finances. This triggered a panic among FTX customers, who rushed to withdraw billions from the platform. The once steady flow of deposits reversed into a stampede for the exits, creating the crypto equivalent of a bank run. Behind the scenes, FTX struggled to meet withdrawal demands. The liquidity that Sam Bankman-Fried had publicly claimed was fine simply wasn't there. As customer requests piled up, it became clear that billions in deposits were missing, funneled to Alameda over the years to fund risky trades, political donations, and lavish spending. The domino effect was swift and merciless. FTT's price collapsed, wiping out the paper value of Alameda's holdings. Lenders demanded repayment, and as the scope of the shortfall became public, regulators from multiple countries descended on FTX's operations. What had been one of the most trusted names in crypto was now a crime scene in the making. Attempts to save the company faltered. Sam reached out to Binance for a potential bailout, but after reviewing FTX's books, Binance walked away, citing mismanagement and potential fraud. The withdrawal freeze that followed confirmed the worst fears of customers and investors. Their funds were gone. And the empire had been built on a fragile foundation of leveraged deception and misplaced trust. In the days that followed, FTX filed for bankruptcy. Alameda collapsed and Sam stepped down as CEO. News outlets around the world reported the implosion as one of the fastest and most complete corporate meltdowns in modern history. The fallout spread far beyond FTX's offices in the Bahamas. Crypto prices across the board plummeted as confidence in the industry evaporated. Other exchanges faced liquidity issues, some collapsing outright, while institutional investors wrote off billions in losses. Even casual traders drawn in by celebrity endorsements and the promise of easy gains found their savings frozen or erased entirely. The shockwaves reached into politics, sports, and entertainment, where questions swirled about the millions FTX had spent on donations and sponsorships. In less than a week, the JP Morgan of crypto had gone from industry savior to public villain, leaving behind a cautionary tale that would redefine how the world viewed digital assets. And for Sam Bankman-Fried, the real battle was only beginning. The collapse of FTX set off a chain reaction of legal, political, and cultural fallout that few could have predicted in full. Within weeks of the bankruptcy filing, U.S. federal prosecutors charged Sam Bankman-Fried with multiple counts of fraud, conspiracy, and money laundering, alleging that he had orchestrated one of the largest financial scams in history. The accusations were staggering. Billions of dollars in customer funds had allegedly been siphoned to cover Alameda Research's losses, bankroll political donations, and finance a lifestyle of private jets, luxury properties in the Bahamas, and high-profile events designed to cement FTX's image as an unstoppable force. As court documents piled up, they revealed a startling absence of basic corporate governance inside FTX. There were no proper accounting systems, few internal controls, and key decisions were often made in private signal chats that auto-deleted messages. In congressional hearings, FTX's new CEO, appointed to oversee the bankruptcy, testified that he had never seen such a complete failure of corporate controls in his decades of restructuring failed companies. For the broader crypto industry, the scandal was a nuclear event. Regulators in the US, Europe, and Asia used FTX's downfall as a rallying cry for tighter oversight, arguing that the case proved the industry could not be trusted to police itself. This wave of scrutiny rattled other exchanges, some of which scrambled to publish proof of reserves to reassure customers they weren't running on the same kind of shaky foundation. But public trust had been deeply wounded. For many retail investors, FTX was supposed to be the safe choice, the exchange backed by celebrities' billion-dollar venture firms, and a CEO who claimed to be in it for the greater good. The realization that all of it had been built on deception left an enduring bitterness, especially among those who lost their life savings. The trial of Sam Bankman-Fried became a media spectacle, drawing comparisons to the collapses of Enron and Lehman Brothers. Every new piece of testimony peeled back another layer of the carefully constructed image that had shielded him for years. Former executives, including members of Alameda's leadership, testified against him, detailing how funds were moved, rules were bent, and concerns were ignored. Meanwhile, political circles were forced to reckon with the millions in donations Sam had spread across both major U.S. parties, prompting questions about influence and accountability. Even the celebrities who had endorsed FTX weren't spared. Class action lawsuits named figures like Tom Brady, Stephen Curry, and Larry David, accusing them of promoting a fraudulent enterprise. While their legal exposure varied, the damage to their reputations was undeniable. Beyond the courtroom, the cultural impact was profound. The scandal became a shorthand warning about the dangers of too-good-to-be-true investments, especially in industries as opaque and fast-moving as crypto. Some analysts predicted it would delay mainstream adoption of digital assets by years, if not decades. Others saw it as a necessary purge, a painful but vital step toward building a more transparent financial system. Either way, the name FTX had become synonymous with betrayal, and its fall served as a reminder that in the high-stakes world of finance, trust can take years to earn, but only seconds to destroy. The collapse of FTX will be remembered as more than just the implosion of a single company. It was a turning point in the history of cryptocurrency. It exposed how unchecked ambition blurred boundaries, and the absence of real oversight can combine to create a disaster capable of shaking global markets. For millions, the story of Sam Bankman-Fried is a cautionary tale of how quickly the line between visionary and villain can vanish, and how easily trust can be weaponized against those who place their faith in the promise of innovation. The aftermath continues to unfold in courtrooms, regulatory offices, and the lives of countless investors whose futures were altered overnight. But the lessons are clear. Transparency matters, governance matters, and no amount of marketing or celebrity endorsements can replace the hard reality of sound financial practice. FTX's rise and fall should serve as a permanent warning to anyone tempted by the lure of fast profits and glossy success stories. In the volatile world of finance, whether digital or traditional, the only constant is risk. And for those watching from the sidelines, this saga is a reminder to look beyond the headlines and ask the uncomfortable questions before it's too late. If you want more deep dives into the scandals, collapses, and hidden truths behind the companies that shaped and shook our world, make sure to stick around for the next story.